Hello and welcome to Raise Your Average. I'm Pierre Daly, Managing Editor at AdvisorAnalyst.com. My co-hosts are Mike Philbrick and Adam Butler from Resolve Asset Management. Our very special guest is Phil Huber, Chief Investment Officer for Savant Wealth Management. Phil leads the firm's investment and portfolio management related functions. He's the author of the recently published book and tour de force, The Allocator's Edge, a modern guide to alternative investments and the future of diversification. Phil has made a name for himself as a regular on and in the Wall Street Journal, the New York Times, Investment News, CityWire, RIA Magazine, and Bloomberg, and was named one of Investopedia's top 100 financial advisors from 2018 to 2020. He also authors a popular investing blog, Bips and Pieces, and is active on Twitter and LinkedIn.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Phil, welcome to the show. It's really great to have you.
It's great to be here. Thank you, gentlemen, for the warm introduction and for having me on today.
Excited about this conversation, actually. It's very timely. Phil, to kick things off, please tell us about the arc of your career, your background, how and why you got into the business in the first place, and what you're focused on these days at Savant Wealth Management.
Sure. I got interested in the wealth management space, really just by growing up around it. My father was and is a financial advisor still. And so he founded a registered investment advisor in the Chicago area back in the late 80s and grew that over time. And so I was just, always knew that he loved and enjoyed his job very much. And so it always seemed like an appealing career path to me. And I think I just kind of gravitated towards finance and investing. Those were subjects that I found very interesting and worth studying. And so I majored in finance through college and had an inkling that at some point I would join the family business. And I did so pretty early on in my career. So I spent, about 13 years at that prior firm, which was Huber Financial Advisors. Eventually we, grew to a size of about $1.5 billion in assets under management. We had just under 30 employees. And so we were really a decent sized advisory firm, but we ultimately decided in early 2020, just about a month before the pandemic hit, we've closed our merger with Savant, where I am now. And so, we had known Savant for many years as kind of a neighbor that, kind of in our backyard. We were North Chicago. Savant is based in Rockford, Illinois, which is a little over an hour away. And so both firms had a long-standing kind of knowledge of one another and mutual admiration. And we thought, hey, I think there's enough good things that each side is doing that we could do better together than separately. And so we joined up forces. And I had been in the CIO role at Huber, and so that was a natural, kind of adaptation for me to move over to Savant and take on that role. And it's been a great experience so far. We're, nearly 2 years into the deal post-close, and it's been a great to join a larger enterprise and be able to affect more lives. And it's been a lot of fun.
I can't believe it's been 2 years. That it feels like
it's wild.
You just announced that like last week, man.
Isn't it weird how, just the 2 years, last year and a half to 2 years in general, there's days I'll wake up and it feels like it was like 10 years ago, and then other times it feels like it was yesterday.
Well, this is the year and a half or so that feels like a decade, I guess. So,
yeah.
Yeah, really.
I guess that
didn't
makes
even
more
consider
sense.
that. It has been sort of a warped existence for the last 2 years.
Yeah, I think we all lost what, sense of time and what time means.
You were playing a similar role at your previous firm, right? When you were at your own RIA, and obviously it was considerably smaller than the current purview of your role. How
Correct.
has your framework shifted as you moved into a capacity where you're now just, not just informing the portfolios or guiding the portfolios for your small group of clients, but rather for other advisors who are then guiding portfolios for their clients, do you think?
Sure. Yeah. I mean, while the role I have today versus at Huber is identical in title, the actual kind of day-to-day responsibilities are a little bit different. On one hand, I'm wearing fewer hats today than I did at Huber Financial, where I was focused on the investment side, but was doing a fair amount of my own one-on-one client work with as an advisor in a certain capacity, and had my hands in different areas of management of the firm as part of the management committee. And so that's one aspect. The other aspect is I was never accustomed to having a large team. I usually had, maybe one or two analysts tops supporting me at Huber Financial, whereas at Savant, we've got a pretty, deep bench of investment talent across our research team. And so I've got a counterpart, Gina Beal. She's our director of research and is based remotely in San Diego. And she and I co-lead the department and the analysts that support us, as well as co-chair the investment committee for the firm. And so I think that's been an interesting and fun experience of just kind of working within a larger investment team, and also just being more kind of focused and deliberate in what I do and not being spread too thin. And so kind of shedding some of the responsibilities, that I used to have. Like one example would be kind of oversight of trading and day-to-day portfolio management. We have just a separate trading function that does all that. And so that was, something that I sort of relinquished, and really, when I think of the role of a CIO in a wealth management firm and what the responsibilities are, like, yeah, a big part of it is setting investment policy and manager research and due diligence and all those things that go into the how we construct portfolios, what types of investment products that we use. But, really specifically, my role is very much communication is first and foremost, the biggest part of my role. And that comes in many different forms. Some of it's one-on-one interaction with advisors and their clients or prospects. Other times it's written communication or webinars or podcasts or all sorts of different ways to reach an audience of one or an audience of many. And so I think we have our portfolios, but as we grow as a firm, like I view the department that I oversee as really a centralized resources or centralized resource for the advisors at the firm. And so whereas at my prior firm, it was maybe 10 or so advisors that I was supporting. Now it's, over 70. And so we have to be smart about how we communicate to our internal audience as well as our external audience. And also we're growing, pretty, healthy clip. And we've been acquiring other firms, even since I joined not even 2 years ago, we've since acquired 3 other advisory firms. So we're constantly adding new advisors to the fold. And I would say generally speaking, the firms that we're engaging with and partnering with tend to be firms that have a decent amount of philosophical overlap in terms of, how, the investment side of the business. And so, but at the same time, every firm does things differently. So there's very much more involvement than I was used to in my prior role of, training and educating the advisors that are joining Savant of here's how we do things a little bit differently than you did at your prior firm. Here's how to tell our story to your clients, just because our objective is not to have a national presence and a bunch of random offices across the country where each office is kind of responsible for their own investment approach. The idea is that we've got a centralized investment philosophy and approach that all of our advisors, regardless of what city or state they're in or what office location, they're tapping into that. And so we're creating a consistent experience for our client base, kind of one firm, one philosophy. And so that's a big part now too, is just that kind of that onboarding and integration of new partner firms.
To what extent do you think your experience as a, on the ground advisor dealing one-on-one with clients feeds into your ability to communicate with advisors at a level that is connected to their day-to-day experience?
I think it's tremendously important that I do have that background because I think at times like advisors, they want us as the research team to be empathetic to what they're dealing with on the front lines and what their conversations with clients are looking like. I think it's a little, it can be challenging if you're a research analyst and you're really just kind of focused on like, here's what the numbers say, here's what works in a spreadsheet versus here's what works in real life. Like at the end of the day, as we all know, the best portfolio is the one that the clients can stick with. And so I think we need to strike a good balance between, what we think is the optimal set of portfolios that we build on paper versus the ones that we think our advisors will have the confidence to deliver to the clients and the clients will be able to tolerate the experience of holding to their own, investment success. And so part of how we try to achieve that is through the construction of our investment committee. And so, there's a couple other eggheads on the committee like myself that are the CFA types that really, spend their livelihood on, researching investments, and that's where their passion is. But we also have membership from our executive team on the investment committee, as well as some of our senior financial advisors. So our CEO sits on the committee, our COO sits on the committee, and then what we do with advisors is we say, we think it's a good experience for advisors to have like a tour of duty on the investment committee, so they get a better feeling of what goes into the decision-making process of the firm and how we build our portfolios. But it doesn't have to be a permanent, membership. And so what we tend to do is, have one, advisor spends 1 to 3 years on the committee. We think that's valuable for them. And so eventually they rotate off, we bring someone else on. And so over a longer period of time, you ultimately try to get, a decent number of your advisors having some involvement and input into that committee structure and different projects that we have going on. So I think it really is valuable to have kind of 3 lenses in that decision-making group. One from the executive kind of business side of the equation, one from the strict kind of research side, and then the other from the client-facing side. And so I think that really helps ultimately, get everybody on the same page and feel that we've got the best solutions that we can put in front of our clients.
I'm guessing it's pretty reassuring for the advisors that you talk to that you're a former advisor, right?
Yeah, and I still work with clients, and a big part of my role is just making myself available when there's a need for an advisor that may want me to sit in on a, what used to be an in-person meeting, now typically via Zoom or something like that. But yeah, I love that stuff. Like, as much as I am fond of writing blog posts and, of course, like some things like the book, like I really get a lot of pleasure of just sitting down with the actual clients and people that we serve. That's really important to me to just have that be a big part of my role. And so I'm always happy to do that when it's appropriate. And I think the advisors like that too, even if not in every meeting, that's just like, hey, for the clients that like to dig deep around the investment portfolio and have the discussion kind of more centered on stuff there, that it might go beyond a certain level of depth that they might not be comfortable with, that I'm happy to come in and share.
Yeah, so, often I hear about advisors getting upset with companies trying to tell them how to do their business or how they should turn their business over or change things or become, whether, and it's a very egotistical business, right? And high conviction business. So when someone comes along who hasn't got the experience, the immediate reaction is, what do you know about being an advisor? But so it's nice to be in, it must be a significant advantage. I'm sure, Adam, you feel that way too, right? So. And
yeah, it definitely is helpful to have had a few years experience communicating these concepts with clients, because it's easy to live out in the sort of nebulous lexicons and concept space that we deal with as kind of people who are passionate about the markets and investment concepts, and then forget that most people do not live and breathe these terms and these ideas and what's going on day to day in markets around the world. So it helps to be connected with that. And I think you're right, Pierre, in some ways it does give you a little bit more credibility with advisors, that they know that you've been in their shoes for many years and can therefore kind of empathize with the experience they're having with clients, right? So I think it's a good point.
Absolutely.
And that's the type of experience that we try to get all of our analysts, to varying degrees. We want them to get that client-facing exposure, even if it's on, even if they're not doing it as frequently as I might be doing. I think it's important for their own development that they understand what it's like to be sitting down with a family who's entrusted us with their money, and really know what those, what that advisor experience is like. Because I think that'll help them be better analysts and just be more appreciative of the work that we do. And then similarly, I think it's important to just have a constant feedback loop between our department and the advisory, leadership team, to just check in periodically, like, hey, like what, sometimes we'll do actual formal surveys. We send out like a survey monkey and have ask some questions, because it's good for us to have our finger on the pulse of like, what are the topics that are coming up most frequently in your client meetings? Are there any gaps in our investment menu that we should be exploring? And so just like continually, asking those types of questions only will help inform our research agenda, the content we produce, to try to make it as useful and timely as possible when they're sitting down with clients. So that's a big part of our process.
Are there any points of note recently as you've you published The Allocator's Edge, a modern guide to alternative investments and the future of diversification? So I want to make sure we get the title out there, because I think it's informative as to what that book represents and how it actually dovetails into everything that you've been talking about up to this point, right? You've got an investment thesis. You've got advisors that have got to convey that to clients who have to own it and keep it in order to benefit from the long-term results of that. So thinking about that, you've written the book, you've had it out there for a while, and we'll dig into some of the other points of it. But is there anything that's come up in this where you're like, oh, I should have written another chapter, or there's a piece missing, or here's actually where the conversations are leading given this new information or this compendium of information that I've provided the world?
Yeah, it's funny. So I mentioned that survey earlier, and this is probably several months ago, maybe it's kind of summertime that we sent this out. But it was an open-ended question, like what are the most common things coming up in your client meetings? And it was almost funny, and I kind of joked, like it was far and away the number one topic was inflation. Clients worried about inflation. Maybe second to that was, stock markets at all-time highs, elevated valuations. Call that the second concern. Third concern, how do I invest in a low-yield world? And then the fourth concern, why do I own these alternatives in the portfolio? Yeah. Which I thought was just hilarious, because when you think of like those first three kind of pain points or concerns,
it kind of answers itself.
Ultimately, that fourth question, like that's why we have the alternative. So what it told me was, well, then we probably need to be doing a better job of what our messaging look like. Because if that's, obviously performance is always going to drive things in the short term. So that's probably causing some of the pain points around alternatives, and that the more line items you have in a portfolio, there's always going to be this likelihood that at least one of them is underperforming at a given time. And so, but at the same time, if our purpose of adding in these non-traditional diversifying return sources into the portfolio is to address those very concerns of potentially high and rising inflation, of elevated stock market valuations, and trying to find diversification when bonds are offering you very little in the scope of yield and total return. That's why we're introducing some of these other asset classes to the portfolio. So I think it was informative to us that we need to really kind of unify this messaging a bit better. But it also made me excited that this was in advance of the book coming out. Like, oh, this is perfect timing. And so what I'm excited about is really taking all the concepts in the book, which again, it's a thicker read, and it was really written more towards financial advisors and investment professionals. We're certainly going to introduce it to clients and make it available to clients as much as we can. But I think not every client's going to want to sit down and read a 300-page book on alternative investments. It's probably not their idea of spending a fun weekend. And so what I'm excited about is how do I take all the concepts in there and adapt it to other, content that we're doing, shorter type pieces, PowerPoint presentations for webinars, things like that. So we're actively working on different ways we can kind of adapt the book to other mediums to try to introduce that messaging and really pound home like this is why we feel very strongly about this strategic component of your portfolio, and here's how we can kind of better translate that to our end clients. That again, let's try to remove as much of the lexicon and jargon as possible, and try to simplify what's inherently a complex playing field.
What do you think is the biggest problem with alternatives, Phil?
I think there's a couple of things that come up with clients. I think clients have grown very accustomed to their stock and bond funds having like rock bottom expenses. That's been the prevailing trend of the past decade plus, of the shift towards passive and towards indexing, where you can own broad stock and bond markets at very, very cheaply. And so when they start to see new funds added to the mix that have decently higher expense ratios, like naturally some of them kind of just pose the question like, hey, you guys have advocated low cost funds, etc. These seem a bit higher. What's the trade-off? Why are these kind of quote worth it? Whereas maybe you're not willing to pay up for US, large cap stock exposure. And so I think that's a conversation that we need to have and kind of educate getting them on, hey, just low cost isn't the be all end all. There's a time and a place for things that are moderate to higher cost. It's just thinking about them and contextualizing when is it appropriate to pay up for something in a portfolio relative to the expected benefits you assume you're going to receive. So cost is one thing, and I think second was just everyone's kind of used to owning stocks and used to owning bonds, and so they're familiar with the experience. Whereas depending on the alternative category, it's just a bit more novel or foreign to the average client. So I think just setting expectations for people and educating them, in a way they can understand of here's what this asset class is, here's why we're introducing it, here's why you should expect to make money over time, here's an environment where it may do well, here's an environment where it may do poorly, here's maybe what to expect from a kind of hypothetical, worst case scenario standpoint. And so trying to just kind of give them a little bit of context on the role in the portfolio, where we're sourcing it from, what we're expecting to get out of it versus just sticking with the status quo. So, these aren't insurmountable, objections, but I think they're just, things that clients should be asking when something new gets introduced is, hey, what is this? Why do I own it? Why is it worth the extra costs involved? And so that's again, we just got to be armed and prepared to answer those questions when they come up.
I think it's helpful too to think about the overall cost in the context of the entire portfolio as well, right? So if you have mitigated a lot of the costs in beta exposures, let's say, and you've got that down to several basis points, adding those alternatives that cost a little bit more, from a portfolio perspective, the overall portfolio cost isn't rising as much, yet the diversification benefit and the opportunity to rebalance is enhanced quite dramatically. And I would also add that, if we go back through time and look at Yale and the endowment there, just as a simple example of the adoption of equities as a core part of a portfolio. When you go into sort of the late 80s, early 90s, most of those portfolios were dominated by bonds. And then they brought in stocks. And the boomers certainly brought in this idea of regularly saving into equity markets over time as a means to prepare for and save for their long-term obligations. That didn't really exist in the 70s and for a good part of the 80s, to be quite honest. Like it was something that the Overton window of acceptance sort of has encouraged over the last 20 or 30 years. And one does have to think about, we are getting at the max saturation potentially of that. I mean, how many more endowment portfolios can go from zero equity to some amount of equity, and some of them have gone on to private equity and whatnot. But I think it pays investors and allocators and advisors to think about that as a means of preparing for a future that may be a little bit different than the past 20 or 30 years.
And I think too, this notion that like 60-40 was always the way to build a balanced portfolio, that's not always the case. The way investors go about, investing is constantly evolving. If you just look throughout history, and largely it's a function of a few things. It's technology, just making things either easier to implement or introducing new fund structures. I think, a good example is just like the ETF, like 1993, I think was the first ETF. Like that's still a relatively new fund structure. And today we have trillions of dollars allocated to ETFs. And so the idea that you could go out and buy, in one fund, something that owns like 2,000 stocks or something, you couldn't, just from a technological standpoint, that wasn't even possible in the 1950s. So it's like, on one hand, you have technology improving and that affects product development. On the other hand, you also have just collectively our understanding of like what makes a good portfolio and what are the kind of best ways to combine things for certain types of outcomes or objectives. That thinking and that understanding evolves over time and continues to improve. And so you see that kind of evolution over time of things that were once sort of, not mainstream, but novel or a bit in their infancy become mainstream over time. And so the same goes for alternatives. You see new asset classes have emerged in prior decades that ultimately kind of gain broader adoption. So it won't surprise me that to see a handful of the chapters that I cover in the book that might be a bit foreign to investors today to become, more broadly accepted as time goes on. And I think too, one area that I think will be in particular become more pronounced is just the acceptance and introduction of non-daily liquid investments into portfolios as more and more products become available. I think that's become kind of a default for many investors and advisors over the years, is just using daily liquid mutual funds and ETFs and other structures. Whereas I think you're seeing kind of a middle ground of a handful of registered funds that have episodic or periodic liquidity windows, where it's kind of an interesting middle ground between like your kind of registered, daily liquid mutual funds at one extreme versus the other extreme, which is, limited partnership, long time lockup, and that might not be appropriate for, a lot of clients for certain reasons as well. So I think having that kind of middle ground where you can introduce things that are a bit less liquid, but not have to go completely into the, the LP space to do so.
Well, why don't we dive into the different alternative asset strategies that you cover in the book, and maybe since you just mentioned it, maybe we start with interval funds and what they are. And I don't think they have direct analogs in Canada, but I still think that the Canadian audience would be interested in the types of strategies that are offered in interval funds, and maybe why the structure is well suited to those strategies.
Yeah, so I guess apologies for any of this that doesn't necessarily translate to the Canadian audience, but for U.S. investors, this interval fund structure is essentially 1940 Act registered funds, where as opposed to being able to buy and sell on a daily basis and redeem and get liquidity on that short of notice, on the sell side there's quarterly repurchase windows for interval funds, where essentially you would submit your redemption requests, at the assigned date in each quarter. And then depending on the amount of redemptions, you either get all of your capital requested back or a portion of it. And so as much as there are those quarterly windows, we definitely kind of want to treat them as long-term, more illiquid investments, because that liquidity is not guaranteed. And the reason that cannot be guaranteed is the interval fund managers are required to purchase up to 5% of outstanding assets each quarter. But if redemption requests exceed that 5%, then your request will get prorated. So maybe instead of submitting $100 and getting 100 back, maybe you submit 100 and you get 75 back, or something along those lines. And so it could, there's a chance that you might not be able to get all of your money out. So should you desire to get it out for a fairly long period of time, depending on how long a gate is imposed. And so that is one unique feature about interval funds that makes them distinct from mutual funds and ETFs. But then when you look at the common attributes to those, pretty widely used fund wrappers, it checks a lot of the boxes of what investors in the U.S. kind of like from a convenience standpoint, in that it's 1099 tax reporting as opposed to K1. There's daily NAVs, and so you get pricing updates on a daily basis. They have ticker symbols that they're kind of registered under the 1940 Act, which kind of from a regulatory oversight standpoint, I think is important to many people. And so it kind of, in many ways, looks and feels and smells like a mutual fund, with that key distinction on the liquidity side. And the reason that is there is because daily liquid mutual funds have a cap on how much they can hold in illiquid investments in the portfolio. And so for certain asset classes, things like private debt or certain types of real assets or catastrophe reinsurance, there's a handful of categories that you can, effectively do inside of an interval fund using these illiquid investments that you really can't do properly inside of a daily liquid fund. And so I think it's a nice kind of middle ground. Again, there are risks involved and illiquidity potentially, but I think for investors that have the kind of appetite and bandwidth to open up a portion of their portfolio to non-daily liquid, it can introduce some fairly compelling diversification opportunities.
Yeah, makes sense. So what are some of the other popular alternatives that you cover in the book? And maybe start with ones that you're more likely to recommend nowadays in the current environment.
Yeah, so my aim with the book was to really make it as comprehensive as possible in terms of the kind of asset class and strategy coverage. And so that's really that whole second part of the book. And, the book itself is really structured into three parts. And I kind of very simply like to think of those as the why, the what, and the how. So part one, the 3 chapters there is just why should I be investing in alternatives? Part 2, what are the different types of alternatives there are? Part 3, how do I think about building portfolios and effectively communicating them to my clients? And so that middle section, I thought it just naturally made sense to follow a past, present, and future framework from a chapter standpoint. And so when I think about what are like the big four, what are like the 4 horsemen of alternatives, the asset classes that when you just say the word alternative in people's head, they start to conjure up these areas. And to me, that's private equity, hedge funds, real estate, and natural resources, specifically like gold and commodities, because those tend to be what dominate most institutional alternative portfolios. And so I thought naturally it made sense to start there and just kind of briefly touch on those areas before kind of moving forward to some of the more modern or less familiar types of alternatives that are in the book. And so other categories include, there's a whole chapter on alternative risk premia, which I just sort of loosely define as systematic approaches to hedge fund strategies. Another chapter after that is on insurance-linked securities. So I mentioned earlier catastrophe reinsurance. That's that asset class, which is a really unique diversifier. And then there's real assets. And so, real estate, which, is alluded to earlier, that's one type of real asset, but there's other categories that can be looked at as well. Things like infrastructure, farmland, timberland, private credit's becoming a very large category as well, alongside the growth of private equity. And within, even within private credit, there's a lot of different types of strategies, everything from, middle market direct lending all the way to royalties and litigation finance and kind of more niche credit sectors. And then kind of finally, sort of what I would deem to be the more novel or sort of, asset classes of the future, if you will. It's things like digital assets that are becoming quite mainstream today, but I think in terms of advisor usage and client portfolios are still, on the earlier part of that adoption cycle. So crypto, being one example of kind of an interesting new-ish alternative, just having coming into existence in the last like 13 or so years. But other things that like art and collectibles that people have been doing from a kind of hobby investing standpoint for a long period of time, but you're starting to see technology platforms, take that experience and those asset classes and offer them to investors in ways where they don't have to have $1 million to spend on a painting or $1 million to spend on a mint 10, Mickey Mantle rookie card or something like that, where they're essentially taking these valuable assets and securitizing them and offering fractional share access at very low minimum. So it's effectively allowing your average investor to build out a diversified allocation to something like collectibles if they were to want to do so, in a pretty efficient way.
It almost feels like the spigot has been opened like wide, and there's this overwhelming, all of a sudden, in maybe 3 short years, there's this proliferation of choices that advisors and investors have access to, and the learning curve is just, it's vast. Like you hear about these new offerings like Masterworks, which lets you buy fractional art, things like that. Really novel, new options that investors have access to. You mentioned crypto. That seems to come and go as being sort of the most exciting option in terms of market-wide attention. But it's
for something that's called an alternative asset, it sure gets a lot of mainstream attention. But yeah, I think it's interesting in the sense of like, particularly some of those apps and platforms that have emerged, trying to sort of quote democratize access to some of these areas. They're almost trying to bypass the fund complex and the sort of intermediary space, just going directly to the consumer in some of those areas. And crypto is a good example of something that almost went in reverse order of how most alternatives go. Usually it's kind of the institutions, adopt first, whether it be hedge funds or private equity. And then over time, the individual investor or the financial advisor community gets more involved. Crypto was the opposite, where it was really more of a kind of retail phenomenon, and then now you're starting to see that institutional adoption take place in somewhat kind of reverse order than you might otherwise expect.
Yeah.
How do you think about as the proliferation of the different assets comes about and they get financialized? How do you think about the potential increase of the correlation matrix as things become more and more subject to sort of the traditional liquidity of markets?
I think you have to assume the correlations will go up, and I think you've almost started to already see that a little bit with like Bitcoin, for example, where maybe where before it had a sort of zero correlation to stocks, now you're starting to see it behave more like a risk asset, and when you have a bit of a correction in the stock market, and I think that's kind of natural. I think we've seen that with other once very uncorrelated assets that have since become more financialized. Commodities would probably be a good example there as a parallel. And so I think, again, as derivatives markets become more, robust and product proliferation, increases, we'll see what happens when the floodgates open, if and when a spot Bitcoin ETF is launched in the U.S. Like, I think it's only natural to assume that the behavior of the asset class will start to be more impacted by macro events and other asset class behavior, as opposed to marching to the beat of its own drum as it tends to have done more historically.
Probably true for baseball cards and wine too. We've had some discussions on the wine market and whatnot, and it's interesting as they as they become financialized, they're going to go through the ebbs and flows of, I think, market dynamics with respect to liquidity.
I think it's only natural to expect that when you think. I mean, probably a close correlation to those with the disposable income of wealthy people, and so if and when that gets disrupted by a large scale recession, then you would probably expect those to not necessarily provide great diversification benefits to equities in such a time period.
What are your thoughts? Yeah, go ahead.
Sorry, Pierre, go ahead. Nope, you go.
I was just going to say, I just I'm curious to know what your thoughts are on what would happen to private equity if it became democratized, versus having been really sort of the stomping ground of institutions and wealthy investors. What happens if private equity ceases to be so private?
It's interesting in that you're already starting to see the lines get a little bit blurred between the two. I think there's a number of large crossover players in the asset management space that it's not cut and dry that a asset manager is a public market stock investor or private equity or ventures. There's a fair amount and an increasing number seemingly that are doing a little bit of both. And so those worlds are overlapping already. And I think there's a good likelihood, it seems, that private equity might not be as defensive in the next downturn as it has been in prior downturns, as multiples have really begun to skyrocket in that space, just because there is so much demand there, and a lot of money chasing a finite amount of deals. And so I think the return experience in private equity is likely going to look a lot different over the next 10 years than it has been historically. So it might not be as dependable as a diversifier. And I don't think anyone should really treat private equity as a true alternative, regardless of the environment, and that it should just be an extension of your equity portfolio, just illiquid in nature. And so, I think you are starting to see it become I hate using the word because it's so overused these days, but democratized. But there are more on-ramps to private equity through wealth management channels now. And so, there is potential for advisors to start accessing this area in a way that they couldn't have maybe 10 years ago. But I think it also begs the question, like, at one point are you introducing multiple layers of fees, through kind of feeder funds or access points? And then kind of like there's the age-old question of, why is this coming to me now?
Yep.
Who passed on this before it, hit our
Finally
channel?
trickled to me.
Yeah, which of the large endowments or pensions or whoever said no to this? So I think from a kind of level playing field standpoint, it would be nice to. We've seen some relaxation and like accredited investor standards that open up the ability to invest in accredited vehicles for more people. But that doesn't necessarily mean that everybody needs to or should own private equity. I think it's kind of one of those gray areas where I think it can play a role for some, but it's not a blanket statement that yes, you should or no, you shouldn't have exposure to private equity. But I think you just need to kind of treat it as part of an equity allocation.
Are you seeing the sort of overlap or creep of that sort of ESG concept coming into some of these alternative investments? So, you talk about private debt, and maybe the private debt fund is focused on, impact or some other, sort of I'll say, not non-financial, but more related to the ESG side. Are you seeing that sort of overlap come in either client demand-wise or coming in from the providers?
I think on the client demand side, slowly, but yes, there hasn't been a wave of client demand of we have ESG and sustainability focused solutions at Savant in terms of the portfolios that we offer where we can have that kind of overlay or tilt. But it's not our core approach. It's really more when there's a client request associated with it. And so I think, as clients become more aware that there are these options out there that might help them align their social or environmental, kind of values or preferences with their portfolio, that there will be some additional incremental demand. I think on the supply side, you guys know this as well as I do, like there's just a flood of, anything with ESG or, sustainability in the name because they realize the potential opportunities. So that part almost concerns me a little bit, just with how much is out there now that's getting kind of put, some sort of label on it of ESG, because I think that, even within alternatives, I think every asset manager is just looking to figure out creatively, even if the fund or strategy they're offering doesn't have an explicit ESG mandate, they're trying to figure out how do I position this in such a way that it can kind of check that box for people. So I think, allocators and advisors need to really be just kind of mindful and honest about that, and a little bit of skepticism can go a long way.
Sure. I think speaking of ESG and alternatives at the same time, it strikes me as they're both you're kind of experiencing the same communications issues and problems with ESG as you are with alternatives, because ESG is actually so abstract and so complicated because of the 17 goals of sustainability, the UN goals, and then the alternatives universe is so vast, and there's been this proliferation of products of both on the ESG and alternatives at the same time, and then the blended products, which we just talked about, where you have alternative products that are ESG. How do you overcome like that? That seems to me like so complicated to actually sit there for an advisor to explain to their clients how something, actually does all of the above, right? And that would, to me, be, it's the advisor's job, obviously, to, responsibility to make sure that they educate their clients on options that they feel, fit into their portfolio. But, it almost feels like it's compounded, like the problem has compounded with, mixing the alternatives and ESG together.
Yeah, it's just more, variables to have to consider and more things to try to decipher, and it can be overwhelming, both for advisors and for clients. And I think, particularly for just like plain vanilla kind of stock funds that are focused on ESG, like you get a million different experiences depending on like who's the index provider, what is their methodology. And so when you start to look under the hood at like the holdings of some of these funds, like it would probably surprise a lot of end clients to see what kind of names are in there. So that's why I think packaged products are really tough from an ESG standpoint, because often when there's a client interest, it's usually specific or related to one or two, really, key things that they care about. And that's why I think something like direct indexing actually is probably more of a, better mousetrap for someone who really wants to, have that alignment in their portfolio with their values. Is that with direct indexing, you can get very granular on what you want to exclude or tilt towards. Whereas when you're, buying a mutual fund or an ETF, you're just accepting that fund provider or that index provider's definition of what it means to be, sustainability minded or environmentally conscious, or, whatever the, niche or broad focus might be. Whereas you can affect that more at your specific, direction inside of a direct indexing type vehicle.
So I realize Phil, your book doesn't make recommendations about what to recommend, but you must have an opinion about certain alternatives that you like in particular, and why you like them. So would you mind sharing a couple of alternatives that are timely, that would fit nicely in a 60-40 type of situation, that would provide the offset to the diversification, to a portfolio that needs the introduction of alternatives?
Sure. Yeah. I mean, without getting specific into funds, I would say, when we look at our current portfolios at Savant, there's really 5 alternative asset classes that we include as a complement to a traditional portfolio. And those areas are things that we can implement for clients regardless of size, because we're accessing them through either liquid vehicles like mutual funds or call it semi-liquid, vehicles like interval funds, where there aren't any restrictions around having to be a qualified purchaser or an accredited investor to own them. And so if we kind of narrow the universe to things under that umbrella, the 5 key areas that we focus on today are, one being managed futures, or trend following, whatever you want to call it. Yep. But just, for us, that's a, compelling diversifier because of its historical reliability when at the worst, crisis moments for equities. So kind of offering that diversification when you want it most, and having a sort of unique behavioral component as to why trends and such exist across asset classes. And so I think the ability to go long short across different asset classes and the ability to offer diversification exactly when you'd want it makes managed futures something that I think should be a core diversifier within an alts mix. Something like catastrophe bonds is another area where that's really kind of one of few structurally uncorrelated asset classes that is not impacted by credit spreads or inflation or equity market valuations. And so that's an interesting category for us as well. Direct lending, middle market direct lending, we like that as a alternative to publicly traded high yield bonds or leveraged loans. I think you're being compensated much more from a yield standpoint than you are in public markets, and that's with traditional fixed income being challenged, the fact that middle market lending is floating rate in nature and offering a little bit more substantial yield currently than public markets, that's a compelling one to us as well. I would say broadly speaking, real assets, so real estate, infrastructure, farmland, timberland, offering some level of stable income as well as inflation sensitivity that could be valuable if this trend, recent trend continues. And then I'll wrap it up with the 5th category being event driven, which is just a compilation of different trading strategies around corporate events, the most commonly known being merger arbitrage, where effectively you're trying to capture a sort of liquidity premium associated with capital market events. And so we like that as a diversifier as well.
So I was wondering we all espouse the case for alternatives, but I'd love to hear you articulate why you think the time has come for people to really consider adding to the alternative sleeves in portfolios. And then I always like to say, nobody finds God on prom night. And this has been a decade for the record books for U.S. equities and U.S. balanced portfolios. So how do you make an effective argument to investors after their traditional balanced portfolios have treated them so well that they should begin to reduce exposure to those sleeves in favor of these products, many of which have lagged those basic balanced portfolios over that same decade? What are some of the more effective ways that you found to communicate the value of these alternatives right now in the context of the last few years of market conditions.
Sure. And I think it's understandable for a investor who their existing posture has been that kind of classic 60-40, especially if it's been one with a pronounced, U.S. equity home bias. It has treated them very well. I think we need to, understand why it has become a bit of a security blanket, both for advisors and the clients in them, because why would you actively seek to move away from something that's done very well for you, is very easy to understand, and can be implemented extremely cheaply? Like it checks a lot of boxes of what people would like in a portfolio. I think what's been helpful for us is illustrating the prospective returns for that same portfolio, demonstrating to clients and showing them like the return experience of the last 10 years has been above average significantly, not only in just nominal, return numbers, but on a risk adjusted basis as well. It's been probably one of the best times in history to have owned such a portfolio. But I think what's helpful is really kind of showing them, particularly for the 40 piece in a 60-40, the math and how, closely your starting yield impacts your long-term performance of the bond sleeve. And I think that math is a little bit sobering at the moment. And so I think purely from a kind of here and now standpoint, understanding that the elevated stock market valuations blended with a historically low yield environment, it's not often in history that we get that kind of dual effect of really expensive stocks and low bond yields. Usually it's one or the other. So rarely do you have both kind of pointing towards a future that's nothing to be too optimistic about. Similarly, I think if you just sort of take a step back with clients and say, forget about low bond yields, forget about elevated stock market valuations, let's assume everything's fairly priced and you can get a decent yield on fixed income. Is there still a case for alternatives? And I think the answer is yes, in the sense that the objective of a allocator, you're ultimately trying to make the best use of the raw materials you have access to and combine them in a way that you think gives you the best odds of achieving a particular objective. And so 10 years ago, 20 years ago, that sort of universe of raw materials or elements that we could combine together in a portfolio was narrower. There weren't as many types of alternatives that we had exposure to or access to. And that's changed. And so I think that we should always expect our portfolios to be evolving with the times, and just to try to maximize the benefit we can get from blending together different asset classes that have different features and characteristics that can complement one another well. And so I think we want to preach the benefits of diversification and try to paint a picture of a future that may not look like the past. And I think a couple analogies, analogies are always helpful with end clients, because it just kind of helps provide a real world example of something that can help, drive the concept home. So a couple of things come to mind for me. One is sports. A lot of clients, like sports or are familiar with sports analogies. And so I'll use the example of a basketball team. And if you're evaluating, post game, like how did each player do? If you're only looking at the stat sheet and examining how many points did they score, going down the lineup, you might pick out a player and say, well, geez, they probably didn't have a good game. They only scored 2 points. But if you go to see their steals and their rebounds, and you see, they had 5 steals and they had 10 rebounds, like that paints a different picture, and that particular player, despite not putting up a lot of points, they're still adding value to the team. And same goes for any alternative. It might not be in your portfolio to get the highest expected return, but it's there for a reason. It's there to provide value when other things might not be working well. And so I think that can be a helpful way to kind of demonstrate when you're trying to get people to think more from a team or an overall portfolio standpoint, as opposed to line item by line item or asset class by asset class, is one. And then I like to use the example of like the iPhone. We're now on the 13th version of the iPhone. And if you, put side by side the original versus the 13th today, like nobody in their right mind would take the original iPhone as their preferred phone. If you think about the core functionality of both, very much a lot of the same things you can do, like make phone calls, text message, surf the internet. But the one today can do a lot more. And I would say the same goes for portfolios. Like, yeah, absolutely, we can build you a 60-40 portfolio. And that was largely the kind of common practice 20 years ago. We can do more for you today. there's other tools in our toolkit that we have that we think can give you a more robust investment experience that's going to have a better likelihood of achieving returns regardless of the economic or market environment that we're in. So, if we have the ability to build a better portfolio, why would we lean on the one that has shortfalls or to it that we don't think are optimal? So I think that kind of you don't necessarily notice the big changes, iPhone 2 to iPhone 3, but when you compare iPhone 1 to iPhone 13, man, it's a much more powerful product, and same goes for, I think we can maybe not as dramatic, but I think we can go a long way towards building better portfolios using certain types of alternatives than we could if we were limited to stocks and bonds alone.
My favorite metaphor, just bringing sports back in, is Chris Cole wrote a full report on Dennis Rodman in his edition. Yeah, I absolutely love that. Where if you were just to look at his points scored or some of the more traditional stats, then you'd wonder why it would have him on the team, especially given the amount of drama that he caused.
I think you could safely say he was a long ball.
Yeah, definitely long ball, right. But it was just amazing when you recognize the power of the second chance points that you got from his just, 6 standard deviation excess performance in his rebounding, right? Just rebounding the ball, kicking it back out and giving guys a second chance. And the impact that had on the game, I mean, it just speaks so directly to the power of alternatives, and especially certain types of alternatives in the portfolio that tend to have their best months when, for example, traditional portfolios have their weakest months, right? It's kind of like, the traditional portfolio that they're shooting, they have a misfire, and, so the traditional portfolio goes down substantially, but the alternative gets the rebound, they go up substantially. And then the alternative kicks some capital over to the traditional portfolio via rebalancing, right? At the right time. And then you're able to get the best of both worlds by getting this second chance to reinvest in the traditional portfolio with more capital, because you're taking money from the alternative sleeve at an opportune time. So it's just I find that to be a really effective way to communicate a specific example of the benefits of alternatives. So I like that.
And I think in general, like if you're an advisor thinking about how to communicate or demonstrate the value of alternatives to clients, try to find it doesn't have to be those 2 examples of sports or the iPhone, but just look for ways to make it real and draw an analogy to something else that they can, kind of more quickly, latch on to.
And then just, excuse me, you have to do that repeatedly. Because if you have a good suite of diversifiers, there's always going to be that line item in the portfolio that looks like dog's breakfast, just before it probably becomes something that is a meaningful contributor to diversity in the way that you would like it to be, rather than the way you don't like it to be. Diversification is something that means it's moving in a different direction than the other things.
Right. And I think too, you can't expect to communicate this stuff once in a meeting and expect that the next time that client comes back to see you that they're going to remember every single word you said. Like you say, you have to be a bit of a broken record on this stuff before, it's going to take a number of at-bats and repetitions before it starts to sink in. So
50 ways to say the same thing.
You keep getting the same question. Why should I do this?
So
I was just going to say that one point that I wondered about was, a lot of professionals reach a limit in their lifetime of learning, and then they stop and they hang on to maybe what are arcane ideas about investing, and even though they're being flooded with new ideas, their excuse for not necessarily learning about those new ideas is that what they own isn't broken, or what they're doing isn't broken yet. And
right.
That seems, my guess is that's a fairly significant cohort of advisors that are resistant to change, or resistant to to learning and then changing.
I mean,
how often do you run it?
They say you can't teach an old dog new tricks. It's I think the longer someone's been doing something a certain way, the harder it's going to be to get them to really get excited about like significant change.
So Phil, when you run into those folks, that that person who fits into that mold, what do you do to break them from that mold?
You just spend time with them. Yeah, I think for the same reason that sitting down with a client's gonna take multiple repetitions for certain concepts to really sink in.
Yeah,
I think you got to appreciate where the advisor is coming from and know why they feel the way they do. But just put in the effort, and that's why I'm here. That's why I have the role I do, is to be that resource. And so I'm just trying to continue. I've only been here not even 2 years now, but yeah, I'm just continually trying to get to know our advisor base as much as I can and figure out what their pain points are and kind of meet them where they are. And all we can do is do our best and provide as much education and resources as we can and eventually hope that it sticks.
My other question is it more often the clients or is it the advisor that's holding up progress?
It can be both. It sort of depends. I mean, there's definitely, as much as we do have a central, it's not each advisor off building their own portfolios. And I think the advisors that we have at Savant, tend to be very much CFP types where they're not excited about selecting funds and building portfolios. They happily outsource that responsibility to me and my team. It's not what they want to be doing or how they want to be spending their time. They want to be doing financial planning work and building and maintaining relationships. And so they're excited that they've got me and my team to be the ones behind the scenes, building the different types of models and things like that we offer at the firm. And so, we try to be a little bit flexible, and then we've got different versions of our models that might, that can maybe be tailored to clients that have certain preferences around liquidity or preferences around, the use or lack thereof of alternatives. So we understand, we have our default portfolios that we think represent the best thinking of our Savant investment committee and research team, but we also want to be flexible, and understand that there are going to be some, situations or use cases where, again, kind of back to that idea earlier, the best portfolio being the one the client can stick with. There might be some clients where they're just more comfortable sticking with a stock bond mix, and that might work for them, even if we don't think it's optimal from our standpoint.
Yeah, I think the idea of the allocator's edge does in itself have some sort of, I don't know, it seems somewhat obvious in plain sight. If you're following, sort of the broad best practices, and there's nothing against best practices, but best practices do sort of connote you have the average portfolio. And if you have the average portfolio of best practices, you shouldn't expect anything but, sort of results that mimic what everybody else is doing. And if you're actually looking for an edge, you have to think about how you're, applying that edge. How are you going to consistently apply that? What are you going to do that's different, i.e. you're going to have different results than everybody else, and how are you going to be able to behaviorally cope with that? I think are all just really important parts of the equation to think about, both as an advisor and then an advisor advising the clients, because the clients don't always realize some of the true nature of the decision making they're involved in at times. But you as a fiduciary really have that obligation to sort of continue to broaden the client's perspective and push them to the edge of their potential comfort zone to some degree in order to, come away with the best solution for whatever the objective function they're trying to realize is.
Absolutely. And I would say, I mean, the title of the book being The Allocator's Edge, I don't want to spoil too much because I want people to read the book, but the allocator's edge in the book is not a specific portfolio prescription of, oh, you should own X% of alternatives and it should be these particular categories and these specific funds. The edge itself is really more of a behavior and a mindset and a set of characteristics that as an allocator you should have when thinking about how to build portfolios. And so I think the advisors and other professionals who are going to gravitate to the book are the ones that are actively seeking that to do better for their clients than the status quo, that really want to not just continue to lean on the security blanket of 60/40 because it's worked, but they actively want to understand this wide universe a little bit better, and have that confidence and conviction to make change. And so, it's understandable that it's going to take a little bit of education, but I think the ones that are proactive about it and that have the interest and the passion, I think hopefully they'll get a lot out of the book in that sense.
So just coming back, so we talked a little bit about why. We touched on the why. There's, low yields, high valuations, all kinds of stuff like that going on. We talked about the 5 major categories of the what. And then we've touched on behaviorally how, consulting with the client, how, what other hows are there that you can give as sort of broad-based advice or tips to those allocators as they think about this problem? And obviously they're going to use the tips the flesh you provide for the bones of the book, because I'm sure they're all going to run out and get this on Amazon. It's a bestseller, isn't it? It's a bestseller in finance category, I think, or something like that.
It's currently the #1 new release in its category.
Yeah, there you go.
So
I'm sure everyone's going to get out there and buy this immediately. But just to add a little flesh, what have we missed on the? I think we've kind of really we've got the why. We have talked about the what and some ideas to think about there. And I thought it was very informative. Your first part of, here's the things that came back on the survey. Worried about inflation, worried about low growth, worried about low rates. Why do I have alternatives? Sort of answers itself a little bit. So that was awesome. But what else have we missed in the how?
Yeah, in the how, so there's really 3 chapters in the how. And one, we kind of touched on this a little bit earlier when we talked about, different fund structures like interval funds. And there's a chapter on kind of containers and contents. And so I think it's important when you're allocating to alternatives, you need to have a fund wrapper or structure that is appropriate for the underlying asset class or holdings. Most importantly is not having a liquidity mismatch of sorts. And so there are a handful of categories you can do fairly well inside of a daily liquid vehicle. There are others where it's more appropriate for something that has periodic liquidity windows, but could still, retain some of the characteristics of other registered funds. And then there's other asset classes like private equity that generally you're just going to kind of have to be more of that kind of true illiquid wrapper. So I think first is just having a better understanding of what are the different types of wrappers out there and what's the nuance between them. So I think most advisors are pretty familiar with the kind of ins and outs of mutual funds and ETFs, but maybe less so with interval funds and tender offer funds and, non-traded REITs and non-traded BDCs and things like that, and just the mechanics of limited partnership vehicles and what all that looks like in terms of capital calls and commitment pacing and things like that. So that chapter, the whole chapter on kind of continuing to educate on that front. The other is just like when you're, there's no, as much as maybe 60/40 isn't the answer going forward, it doesn't necessarily mean there's one answer, to that. I think there's many different answers. I think really it's just figuring out what are the objectives that you are trying to achieve on behalf of your clients and figuring out an alternatives allocation that makes sense there. So I think a couple of decisions are really key and important. One is sizing the allocation, and 2 is sourcing it. And that's going to be a function of A, what categories are you interested in allocating to? Will inform the size of the alts bucket as well as where you're taking it from. Is it coming from stocks? Is it coming from bonds? Is it coming from some combination of the two? I think generally speaking, it more often than not, it's going to come from some combination of the two, but not necessarily always. And then in terms of sizing, it's going to vary. I think it needs to be enough to matter and to make a difference, but maybe not so high of an allocation that it's going to kind of test the boundaries of what clients can stick with. And so that's going to be a decently wide range. And I think that's going to vary by advisor to advisor on what that, sweet spot is for them. And then I think with alternatives, there's just a host of other considerations to have to really put a closer magnifying glass on relative to traditional investments, things like due diligence, things like tax consequences, things like costs. So it's just other kind of factors throughout the diligence, process to consider that, that you're going to be doing for any fund or manager that you're evaluating. But there's kind of more moving parts and a bit more complexity with certain alternative categories, as well as more dispersion. I think that's another key thing too. I think, if you look at the universe of large cap U.S. stock managers, relatively tight bands of over and under performance relative to the index for the category. Whereas, pick your favorite liquid alt category, you get, I think, a much wider dispersion of returns from your top and bottom performing managers. But then you also get a varying mix of kind of beta and correlation within those as well. And that's the other tough challenge with alternatives, is it might have alternative in the name, but if you really kind of peek under the hood, it might just be really expensive beta exposure. And so I think that's another thing that advisors need to be careful about is, the past returns might look great, but it could have just been because of the rising tide of, equity markets that have buoyed returns. And so I think, really just not being too trusting that it's going to behave in an uncorrelated fashion just because it, belongs to a certain Morningstar category. I think you need to go beyond that.
I think that whole subject at the end there, Phil, is probably the topic for a whole other hour.
Yeah.
The idea of structure. I mean, how many times have we all seen the right product put in the wrong structure? Disaster, right? Mm-hmm. That happens all the time. Taxation, another great point. And then, as you say, you're looking for an alternative manager, and you're like, wow, this alternative manager, look at how it's just done so great when all the other alternative managers haven't, because it wasn't alternative. It was just in the beta that you thought you were trying to sort of get an alternative exposure to. So
everything you thought you were moving away from you were actually just maintaining, but just paying a premium for.
Exactly.
Yeah.
So I think we should probably we've been at this for about an hour, and I think we've covered the stuff, the key contents of the book, and I think we'll have another visit with you at some point down the road where we dig into maybe more deeply some of the topics that have.
Hopefully over pints in Chicago.
Yeah, no, I would love to return at some point. It's always a pleasure to chat with you guys and a lot of fun. So
where can people find you, Phil?
You can find me in a few spots. I'm fairly active on Twitter, and my handle is @BipsandPieces, BPS and Pieces. And then that's also the name of my blog. So bipsandpieces.com is the blog. You can find the new book, pretty much wherever books are sold, but I would say Amazon probably should be your starting point, as most books are sold there today. And then my our company website is savantwealth.com.
That will all be in the show notes. Yeah.
Brilliant.
So, Phil,
Okay. Phil, thanks, man.
Thank you.
Yeah.
Congratulations on your book. Congratulations on the Allocator's Edge. It's a really timely book. It was about time someone published a detailed and insightful look at the universe of alternative investments and where they fit, most of which were not available to investors just a few years ago as they are today. Phil, thank you so much for your time. It's been really a great conversation.
Thank you so much for having me, and would love to come back one day.